asked to talk about the risks, the shades, the darker side of crowdfunding, and it's not the standard presentation that I would give, but it's an interesting intellectual exercise nonetheless. So very quickly, I think Dan did an excellent job of introducing me. I was able to hear you when I was able to hear the last presentation, which was excellent. So I'm not going to spend very much time introducing myself. In the last year, most of my energy has shifted away from sort of micro-entrepreneurship and how crowdfunding can be used locally in studying and looking at policy more broadly as to why crowdfunding matters. And I'll give you one quick example to put some context. It's a U.S. example. I forgive the U.S. centrism here, but it's an interesting one nonetheless. Which about 3 months ago, I was on a telephone call with a gentleman named Ash Carter, and he was just made our Secretary of Defense by our presidents about 2 months ago. And he was incredibly curious about crowdfunding and alternative finance, and he had just retired from our Department of Defense before he had been called back into public service, and I was very curious why someone with a 30-year history of national defense would care about crowdfunding, and he said that it's not for public consumption, but he actually believes that the crisis of entrepreneurship and lack of access to capital and the lack of institutional structures to meet the financing demands of the burgeoning middle class globally is a greater threat to international security than terrorism. He wouldn't say that now that he's back in office, but that's what he told me privately. So there's a huge, interesting, larger context, and I'm going to spend some time talking about both the context driving crowdfunding and a little bit of the risks itself. So this is how most regulatory agencies look if you were to go inside their offices. They, whether it's our U.S. Securities and Exchange Commission or many foreign governments, regulation is built on paperwork and processes, and even if there is some IT or ICT being used, ultimately, in most cases, regulation of finance and regulation of crowdfunding still relies upon paper. In the United States, there are 600,000 pages of regulations and interpretations of our securities laws, to put that in context. This is the level of technology that our governments have been using for the last 80 or 90 years to protect investors, meaning a disclosure-based regime or basically a bunch of documents that are filed and frankly not read by the vast majority of individuals. However, technology is evolving quite rapidly. I hope some of you are Star Trek fans, for those of you who are not. And we're seeing two things happening. First of all, there's a massive disruption about to occur or already occurring in the financial technology space, where very smart companies are figuring out how to use big data techniques, algorithmic learning, and aggregation of data through social sources to make decisions about you as consumers and small business owners in ways that most banks simply are not able to keep up with, let alone legally allowed to do. So we have a tension emerging where financial institutions, meaning central banks, national banks, larger organizations that are heavily regulated, are unable to move as fast as the technology firms. Bill Gates, the chairman of Microsoft, well, former chairman of Microsoft, quipped in 1996 that that banking is necessary, banks are not. So there's sort of an open question right now as to who will emerge as the financing agent of 2030, whether the world will be doing its banking on Alibaba or Google or Yahoo or some other network, or whether banks will continue in their current form. During this crisis, Wall Street and the financial institutions continue to party on. They don't seem to recognize the fact that their high-frequency trading and derivatives-based trading and securitization models are creating a very large political and economic crisis globally, where the vast majority of all profits are captured by this high-frequency trading machine and not accessible to the average investor or consumer investor. They also are fairly oblivious as to the changes in financing models that are about to occur. Some banks are starting to partner with or invest in these alternative platforms, but the majority of financial institutions simply aren't taking the disruption seriously enough. When they look at us, they think that this is what most entrepreneurs look like. Naive, non-sophisticated, full of dreams and aspirations, but not really to be taken very seriously. This is the way that many institutions still think of crowdfunding. It's cute. It's something that is a great way of selling t-shirts or having a rock band or funding a concert, but they don't see it as a fundamental sociological or technological revolution. And because of that, the regulators aren't spending sufficient time and attention to craft regulations to allow it to succeed. This is what the face, and again, I'm sorry for the US-centric picture here, this is what the face of change is going to look like. Young people in their 20s and 30s, the millennial generation, this is, I'd say the average person doing crowdfunding in Western Europe and the US is somewhere in their mid-30s, maybe a little bit younger. What we're seeing is a fundamental recognition among the younger generations that something serious is afoot, and yet in the older generations, they still believe their financial markets are going to operate as usual without any risk. But here's what's going on underneath this discussion. We have the rise of the global south. We have economic disruption. Ironically, I was asked by our US State Department a few weeks ago if I would travel to Tunisia because the US government is trying to stabilize many of the countries in the Middle East that had the Arab Spring uprising, and they're looking at doing some financing innovations to try to deal with rampant unemployment of youth. In some cases in the Mideast, Africa, and South America, unemployment among youth is as high as 50–60%. So there's a significant unrest. Now the positive part of the story is that when I travel internationally, and my good friend Dan can attest to this as well, he and I frequently are globetrotting talking to entrepreneurs, there's this new class of essentially global youth between their early 20s and late 20s who are essentially the same everywhere. They're technology savvy, they have a very similar set of expectations, cultural beliefs, norms. They're totally comfortable with web-based interactions. This millennial or post-millennial generation is the first true global generation where people in Africa and people in Asia and people in the United States and South America are more similar than they've ever been at any time in the past. But these people have lack of access to jobs, lack of access to investing opportunity, and massive social disruption is going to occur if we cannot match financial institutions and financial structures to the demands. There's approximately 3 billion more people will raise to the standard of middle-class living in the next 10 years, but our banking systems and financial systems are totally and utterly incapable of matching or meeting their needs for access to investing or access to financing for SMEs. We see, unfortunately, a decoupling of a lot of the financial models globally. I'll pick on the United States as an example, which is we're having fairly significant growth in our gross domestic product, actually extremely healthy, yet job growth is flat to negative and real wages are decreasing. So most of the laws of macroeconomics have to be reevaluated because we're seeing for the first time historically no connection between gross domestic product and job growth. And that's especially true for this generation, which is demanding access. And this is unfortunately going to occur broadly and internationally. So here are some of the risks that we need to be aware of. First of all, I've been spending a lot of time with governments lately, and I believe that the majority of governments have failed to adequately study these evolving markets to craft regulations to encourage them to be successful. And as the banks start to panic about the intrusion into their revenue models caused by alternative finance, and an example of that is There was a study recently released that suggested that a platform called Lending Club could erode as much as 9% of the small business, consumer lending in the United States next year. So there's a lack of access to finance globally, and one of the main reasons for that is that for the last 30 years, the majority of financial institutions and banks have moved away from a model of investing in business and investing in risk and taking a long-term perspective to an extremely short-term transaction-based model of investing in consumer debt and securitizing and selling that debt off, which led to the global meltdown in 2008. Now let's pick on crowdfunding, since I was asked to speak at the DART forums. Failure is rampant for multiple reasons. First of all, there is an assumption that crowdfunding is relatively easy, that if you put up your campaign, people will magically fund it, and the data clearly shows that the vast majority of campaigns are not going to be successful, and most of that I can attribute to a lack of preparation, a lack of market research, a lack of sophistication, and frankly, it's a lack of devoting enough time to make crowdfunding successful. It is very time intensive. Once there is success, we're seeing massive problems with fulfillment, with delivery of products, with failure to account for taxation issues, lack of forecasting. Unfortunately, we can be victims of our own success, and so someone with a brilliant idea who tries to crowdfund a new enterprise may not have put in enough processes to be successful once they have received the money. The other variation on that is there is a certain component of entrepreneurship where you have a wild dream, but you haven't actually gone out and tested and validated that in the market. And unfortunately, I've seen some examples where people have been able to secure crowdfunding for something that is fundamentally flawed and is not going to work, but our people are still supporting the passion of those individuals. And the problem is these examples can lead credibility to our critics who believe that crowdfunding is not really viable. And when people are doing campaigns to poke fun at crowdfunding, like the potato salad famous example, it suggests that there's going to need to be some additional curation by platforms if trust is going to be maintained on those platforms. Fraud, of course, the boogeyman that everyone speaks about. Globally in Western markets, there's not a significant amount of fraud. However, in the Middle East, Caribbean, much of South America, there are extensive models of very rampant financial fraud and securities fraud. So the challenge we have is many of the proponents and leaders of crowdfunding are coming from environments where we don't have significant issues with financial fraud, and I think we underplay its risk. I was in Egypt a few months ago and was speaking to the university president there, and he basically said that the vast majority of entrepreneurs assume there's going to be corruption, so they figure out how to circumvent regulations in order to survive. But markets like that, security regulations are going to be challenging. Then let's assume that we have an equity market which has success. We have a significant issue of liquidity. So are these shares trusted? Have we got enough to educate individuals to actually have an active and robust trading in these new asset classes? If there's not liquidity, the markets have a very significant chance of collapse. Then you have the risk of investor expectations. Are these long-term, illiquid, high-risk investments, or are these going to be seen as short-term technology investments into a burgeoning industry where people expect to see outsized returns because it's somehow web-enabled? And I know that's the number one concern of our Securities Commission, is trying to figure out, educate consumers about the actual nature of crowdfunding investing. So, despite my good friend Dan's excellent book, Crowdfunding Revolution, I'm going to say that what we're right now is we're looking at truly an evolution. It's an evolution of markets and technology and social models. And this is actually the positive slide. I want to end on a positive note here. Using the expression, the genie's out of the bottle, this cannot be undone. Crowdfunding is a natural evolution, a way that people communicate. It has historical precedents going back thousands of years in the nature of mass risk, of shared risk-taking. It cannot be undone, so the challenge is that as we see this massive increase of technology-enabled cooperation and collaboration, how do governments and institutional structures facilitate it? I'm going to skip over these two slides, but I'll make these available to everybody. But essentially, I see alternative finance as essentially a new model of capital investing and a relatively low-risk way of getting and supporting micro-enterprise entrepreneurship. And then the actual significant benefits of crowdfunding, oftentimes, in my opinion, are the non-financial benefits. Market learning, signals to the market, decreased information asymmetries. A lot of factors that go into crowdfunding that are not talked about in the majority of the discussions. I know that Ben, Barry, and others are aware of it many times that aren't discussed adequately. So with that, I think we're seeing a shift from the collaborative economy to what I call the dawn of collaborative capitalism. Crowdfunding and alternative finance are one of the first models of this. So despite all the risks and frustrations that I expressed in this presentation, I think the ultimate story in 2030 or 2040 is crowdfunding will be seen by history as a significant evolution in this collaborative economy. And with that, I'm going to wrap up and allow you to ask me questions. Well, thank you.